What happens if you are a new real estate investor and you find a deal, but you don't have any money? Today, we're going to talk about using other people's money to actually fund your first deal and how to do it legally. There is a lot of ways that you could actually be using other people's money by borrowing it, by doing a profit share, and it's not actually legal unless you do it as a security. So that's where you get involved with SEC regulations. We have brought on an SEC attorney, Mauricio Rauld. Along with that, we are also bringing in a rookie investor, Kerri. Kerri's going to be asking Mauricio some of the questions that she has as she's looking to buy her first property. Now, Kerri has found a commercial building that has 2 apartments and has a commercial business in the bottom. So Kerri's exploring her options as to how she can find money besides looking under her mattress to fund this deal. But she's very unclear as to the best way to structure this when bringing on partners that are bringing her money. So let's introduce Kerri and Mauricio. Kerri, Mauricio, thank you so much for joining me today on the Real Estate Rookie YouTube channel.
Thanks for having me. Looking forward to this.
Kerri is here as a rookie investor and has some questions for you, Mauricio. So Kerri, what's your first question?
Yeah, so I was wondering, what are the most common ways people raise capital for real estate investments when they don't have the funds themselves?
There's a couple ways you can raise money when you're acquiring a piece of property. The most common way is to literally raise money and give people a piece of the company or equity or shares in the company. In a normal real estate transaction, you're probably going to create an LLC, for example, right? We typically create limited liability companies to own the property. And you would, if it's just you would own 100% of that limited liability company, right? But when you're raising capital in exchange for that money, you're going to give away a piece of that LLC, right? So whether that's 50% of it, 80%, it depends on how much money you're raising, how much money you're putting in. I will tell you that generally speaking, if the people who are bringing the money are bringing in all of the money, and you are bringing in sort of your expertise and putting it all together, most of these deals are structured in a sort of 80%, 20% split, where the investors are putting up all of the money. They're going to expect to get 70 to 80% of the profits. And then you're finding the deal and doing all the sweat equity and doing all the hard work. You would generally then get 20 or 30% of that profit. But essentially, it's usually just a straight profit split. So whatever profits are of the project, it'll get split between you and the investors. Now, that's for a larger project for multiple investors. If it's just one or maybe 2, the other way you could potentially structure this is through a note, a promissory note, right? That way, they're not participating in the uptake. It's very similar to getting a loan from the bank, right? You've got, let's say, Mauricio, I'm sitting on some cash. I'd like to place it. I like your deal. I can lend you money, right? I can lend all of it, a piece of it. Ideally, it's secured by the property. But we can have a promissory note lender-borrower relationship as opposed to an owner relationship. The benefit for you, of course, is that you would keep up all of the upside would be on your end because I'm a lender. So I'm just going to get paid my interest rate, whatever that is, depending on whether it's secured or unsecured. And any upside is all yours. I'm going to be protected as the lender because I'm going to get paid first. I'm a little bit higher on that. We call that the capital stack, right? Who gets paid first? Just imagine when you're buying your personal residence, you have a mortgage, right? The bank gets paid first. No matter what happens, the bank's going to get paid first. They're going to get their money. And then whatever profits are yours or you split with your investor. So in the lender-borrower relationship, that's another way you could structure it so that you don't have to give up all the upside. The downside is you've got to make those monthly payments just like the bank. You know, if you're relying on the income from a property and the income isn't there, that could be a potential issue. And then the last way people will structure, which is challenging, would be what we call a joint venture, right? If you've got a small amount of investors or a small amount of people, so let's say the three of us want to get together and say, hey, let's all join forces. Let's buy this together. We'll all roll up our sleeves. We'll all go do the work and we'll split the profits 3 ways. That's another way. But the most important thing to understand, anytime you are taking money from passive investors where the returns are generated by your efforts, meaning you're doing all the work and the investors are literally just writing you a check, you are now selling securities. I know it doesn't make a ton of sense, especially if you're dealing with real estate, but as we mentioned before, most likely I'm going to be giving my investor a piece of the LLC, right? That's basically shares of my company or LLC units in my LLC. That is the issuing of a security to the investor. So the investor gives you money, you issue them the security, which is the piece of the LLC. But when you're generating the return, when the returns are reliant on you doing whatever it is that you're going to do, then you're selling securities, and we have to comply with securities laws, which is where it gets a little bit more complicated.
As a rookie investor, you would say in most cases for your first deal, that's not a huge property that you're purchasing. You want to stay away from that.
Yes, because there's a compliance cost, unfortunately, to selling securities, right? You've got to hire a securities attorney. You've got to give out a ton of disclosure documents. There's documents, you may have heard terms like a PPM, which is a private placement memorandum, which is like all the ways this particular deal could go wrong, and you could lose all your money, all those kind of risk disclosures, all the information about you, Kerri, what's your experience. Like, it's a lot of disclosures that we have to provide. And so there's a cost involved. And so if you need a couple $100,000, for example, for a particular project, spending $15,000 or $20,000 to put all this thing together just doesn't make any sense. And so if you're in that position where you're looking to raise a smaller amount, and when I say smaller, I mean anything really below $1 million, maybe even below $750,000. So again, your first single family, what have you, then we really want to get as creative as we can to not issue a security, because if you're issuing securities, you're in trouble in the sense that you got all this compliance. So how can we structure this so that we're not considered a security, but on the other hand, just calling it not a security doesn't work? Like, we have to literally structure it properly. And that's where we kind of get into this realm of promissory notes, which is a really, essentially, you would think it's a very simple question. Like, yeah, I'm just issuing a promissory note. Why is that so complicated? But whether a promissory note as a security is an incredibly complicated thing, especially if you're rewarding your lender with some profit share. Like, if you're just doing like a hard money loan, for example, like think of a hard money loan, right? Like, Mauricio, I've got $500,000. You need $500,000 to buy the property, and I loan you that money at whatever the interest rates are. Let's say it's 12%. It's hard money, so maybe it's 10%, 12%, and I secure it in first position. I'm probably okay. It's probably not a security, right? So that's probably the easiest way to do it. But if on the other hand, you want to say, well, Mauricio, I need your money. It's going to be unsecured, and I'll just pay you 50% of the profits. Well, now that starts to look more like a security. So as long as you treat it like a bank and think of a hard money lender in that sense, and I'm just loaning you money, I'm getting an interest rate, I'm getting paid. You could probably pay me interest only, or principal and interest on a monthly basis. But if it starts to look more like a traditional loan that's secured, that's going to look like something that's going to make more sense if you're buying a smaller property and you're a rookie.
Can you define the difference between a secured loan and an unsecured loan?
Yeah, so a secured loan is a loan that has some sort of collateral attached to it. So in real estate, it would be like a mortgage, right? So I lend you $500,000, and then I'm going to put a lien on the property so that in the event you can't pay me, you miss payments, you go into default, I can then go to the property and I can sell the property. I can go into the foreclosure procedure, so I can sell the property to get my $500,000 back. In an unsecured loan, there is no collateral. So if you default on the loan, I can only look towards you to get repaid. So do you have other assets I can come after? Do you have a job? Like, how are you going to give me my $500,000 back? It's very, very important. And the interest rates that you're going to be able to charge is going to depend on whether it's secured or not. If the loan is a secured loan, typically the interest rate's much lower because it's a safer loan for me. Because if you can't pay me, I know there's a piece of property over here with a bunch of equity that I can then go foreclose and get my money back. If it's unsecured, my risk is way higher, because if you don't pay me back, now what? Like, you may not have the money to pay me back. I might just be at a loss. So usually you compensate that risk by charging a higher interest rate, which is why you typically see mortgages from a bank much cheaper than an unsecured loan that your family member made, because there's no recourse against the property in the event that you default.
What type of agreements or contracts should be in place to protect myself and the investor?
Yeah, so the agreements will depend on how you're structuring the deal, right? So if it's a security, which I know we're trying to avoid, remember, I am a securities attorney, so that's what I usually live in, but I also recognize that if you're trying to raise a smaller amount, 200, 300, 400, maybe even 500,000 or 600,000, that doesn't make a ton of sense. But let's assume it does, and you want to do a securities offering and raise money properly and all that stuff, you would have a bunch of documents, which would be we talked about it earlier, a PPM, which is a private placement memorandum. That's a disclosure document. That's no different than when I don't know if you guys I've had so many surgeries, especially like even oral surgery to get my horrible teeth out. But like when you go to have surgery, right, you go to the doctor and they give you that medical consent form, like the yellow shade, and they're like, hey, you're going to go into like, I would have my wisdom teeth taken out. And it's like, well, you could have some bleeding, you can get a little bit of infection, you could die from getting your wisdom, like all those risks from the wisdom teeth. You sign that yellow piece of paper and say, yes, I agree to all these risks. Then the doctor signs it and then boom, you're off to the races and you do the surgery. Same thing here. You're issuing a security, so you're disclosing to your investors all the possible ways they could lose their money, all the risks involved. They read it, they sign off on it, you sign off on it, and that's your kind of your legal document that protects both the investor because they have all the facts there, and it protects you because you've made all the disclosures. So you generally would see a private placement memorandum. Because they're going to be owners of the company, you'd also see an operating agreement, right? The investors will own some percentage of your LLC, so there'll be an LLC operating agreement. There'll be a subscription agreement, an investor questionnaire, because I want to know what's your net worth, how much income do you have, are you accredited, not accredited, a lot of things like that. And then usually there's a business plan, some kind of a pitch deck or business plan. Hey, I'm looking to raise $500,000 in order to go buy this property, do this, do that, and this is how we're going to make money. That's if it's a securities offering. If it's a joint venture where it's 2 or 3 people that are kind of just getting together and everybody's, doing the work, then you're going to see a lot simpler documents. You're probably going to see a joint venture agreement, a JV agreement, which might be separate from an operating agreement or might not be. They might be combined into one. So because there's going to be an LLC and we're all going to be members of that LLC, so you'll have an operating agreement. But honestly, that's probably all you're going to have on the front end. You're going to have other things that you're going to want to document, like your meetings. And so you'll have minutes of meetings and things like that. But from an upfront perspective, primarily a JV agreement, a joint venture agreement, and an operating agreement. And then if it's a promissory note, then you're going to have a promissory note, right? So it's going to be probably just a promissory note where say, hey, I agree to lend you $300,000 and you agree to pay me 10% interest paid monthly for the next 3 years or 5 years. It'll describe if it's secured, if it's not secured, and I'll just have a promissory note. And then if it's secured with real estate, then there'll be something called a deed of trust or some kind of a mortgage document that then will get filed with the county recorder's office so that my lien is perfected. And so anybody that does a search on your property will see it's like the bank. Mauricio's got a lien on that property. So if you're looking to get a lien on that property, get in line, literally get in line. Mauricio's number 1. And if Ashley wants to go put another loan on there, great. But Ashley's going to be number 2 behind me, meaning I'm going to get paid first if we foreclose. And if there's any money left over, we'll give it to Ashley. But if there's not, Ashley will be out of luck.
That's usually in all aspects of everything. Mauricio, right. Number 1, Ashley, number 2.
No, I know going into this first time, there's going to be a lot of mistakes, a lot of humps in the road. So kind of trying to think ahead, what are the common mistakes that first-time investors make when they're structuring deals with private lenders or equity partners?
Yeah, I think the biggest mistake is not realizing that most of the time they are selling securities. They're going out there and they're like, hey, I just need some money to help me buy this property. Maybe it's a private money loan, or maybe I'm just raising money and maybe it's just a profit sharing agreement. They're just whatever the structure is. And they don't even think about maybe I'm selling securities and I have to comply with securities laws, which makes sense. Like, why would you even think of that stuff? But that's probably the biggest mistake, because then people start saying, well, it's just a promissory note. It's not a security. Well, that's not true, because it depends on how the structure is. Or my favorite is, hey, this is a really small deal. I'm going to structure this as a joint venture. This is my favorite mistake that I would say most rookie investors make, is that they hear about this joint venture agreement. That's not a security, so that's great. So let's just call it a joint venture. And voila, we've solved all our problems. I don't have to spend a bunch of money complying with securities laws. The problem is you don't get to make that decision, whether it's a joint venture or a securities offering. The structure of your deal, how you put the deal together, will dictate whether it's a securities offering or a JV, right? So in order for it to be a true joint venture, everyone has to contribute to the returns of the project. We're all rolling up our sleeves. There's usually less than 5 people total, but let's say the 3 of us get together and we all roll up our sleeves, and I'm doing this part of it, Ashley's doing another part. Everybody's contributing to the return. Then yes, we have a nice joint venture. Everybody's a third owner, and we do our thing. Most joint venture agreements I see, there's always 1 or 2 people that are just passive. They just write the check and they don't do any work. Well, you can call that a joint venture, but it's really a securities offering. It's an unregistered securities offering. Those are kind of the biggest mistakes, is just not realizing that what you're doing is actually selling securities and having to once you realize that, you've got to either register it or find an exemption. That's kind of what we have to go through. And people think that because it's a small amount or because it's a promissory note, because it's a joint venture, somehow we get around that. And you may well be able to get around that, but you've got to talk to somebody, primarily a securities attorney, to help you navigate that and make sure that the way you're structuring it gets you outside of the securities laws. You really have to try and figure out how to get outside of the securities laws, because again, spending $15,000 or $20,000 to set this thing up when you're only needing 200 grand, the numbers just don't pencil out.
Right. That makes sense.
I have a question as far as like the legal risk. So, you kind of went through as to how you can legally structure it and set it up. What about raising the actual money as to, can you post it on social media and say, hey, I need an investor to fund this deal? Can you give Kerri some guidelines?
Let me just backtrack a little bit, really high level here. But if you are selling securities, let's go with that first. If you are selling securities, meaning you're raising money and you're doing all the work, investors are just going to write you a check and go home, then the rule is you have to either register it with the SEC or find an exemption to registration. Or it's illegal, as I like to joke. So depending on what exemption we go with will dictate whether you can go on social media, whether you can advertise, whether you can take non-accredited investors, which are sort of, sure, somebody has a high net worth, over $1 million in net worth, excluding their home, has earned a couple $100,000 in income. That's an accredited investor. Sometimes you're limited to only accepting accredited investors if you're going with a particular exemption. So if you're doing a security, it's really important to figure out what exemption am I going to rely on, and then let's make sure we follow the rules of that exemption, and those exemptions may or may not allow you to advertise on social media. Most of them, to be honest with you, do not. Most people rely on an exemption that does not allow you to generally solicit or advertise. That's really meant for your people in your network and sort of a private thing with you, your friends, your parents, your family members. But there are some exemptions that would allow you to advertise. Now, if you're not selling a security, right, let's say you're doing a legitimate promissory note, like a hard money loan, then sure, you could then go on social media because there is no prohibition. You're not selling a security. So if you go on social media and say, hey, I need somebody to lend me $500,000 and I'm offering, a 10% interest on the money secured by the real estate, please reach out. That's something you'd probably get away with. But that's only because it's not a security. That's why it's so important to figure out, A, if it's a security to begin with, B, if it is a security, how do we make it not a security? Because that'll all dictate what you can and cannot do as you're looking for people.
And you don't take 20 responses and say, oh, okay, all 20 of you split the 500,000 and then you have all of those people lending you the money.
So that's something, and even with promissory notes, generally in order to avoid the securities, you don't want to fractionalize notes. I mean, you want to have sort of one promissory note for one person, for one project. It's secured with the property. So it's really one-to-one. Once you start having multiple lenders, let's say I need $500,000. If I start getting 5 people to give me $100,000 loans, now you're fractionalizing that note, and that's going to be a security.
So in the end, what happens if I can't pay the investor back or I lose their money?
It depends how it's structured. So if it's a secured arrangement, right? So if it's a promissory note that's secured by the property, you can't pay the loan, then generally I'm going to be able to, assuming there's equity in the house or in the property, go into the property, liquidate it, pay off all the whatever other loans are there, and whatever's left over would be to pay off my loan. That's kind of the ideal thing. If they're equity owners, well, the LLC owns the property. So same thing. If you can't make the payments, or usually if it's equity, by the way, you're not promising payments. You're just going to give them a percentage of the profits. So if there's no profits, there's no distributions anyway. But theoretically, the protection for the investor is, hey, I'm an owner of the LLC. The LLC owns the property directly. It's not even a lien. I own the property. So again, I can sell the property and at least recover some of my money. It might be at a little bit of a loss, but if I can sell the property at 80 cents on the dollar, I'm going to at least get, some of my money back. So those are kind of the protections that are there for the investors. And then the protections, but the risk is on your end. The risk is for you is if you go raise money and for whatever reason you can't pay back that money, that's problematic for you, right? Now, again, if it's this is the nice thing about securities, doing it as a security. With a promissory note, you're typically obligated to make the payment. The lender doesn't care about, you just got to pay me. I'm lending you money. You got to pay me back. But with a securities offering, that's not the case. In a securities offering, I'm giving you money and we agree to split the profits. But part of the risk disclosures that we make is like, hey, you may lose all your money. I might buy this property, the market might turn, we may lose it, and you're going to lose all of your money. But if you've done it properly, structured it properly, and done all the disclosures, you wouldn't be on the hook for that loss. You're certainly not promising them a return. You're not guaranteeing them a return. You're just saying, hey, I've got this cool project. I think we can make a bunch of money. If you give me money, I'll split the profits with you. 80, 20, 70, 30, 50, 50, however you're going to split the profits. But if the project doesn't go according to plan, I never meet a price. Now, if you violated things, you could be on the hook for it, right? If you didn't follow securities laws or you made a decision that was a bad decision and that bad decision led to the loss, then they can come after you for that. But just for the fact of raising money in a securities offering, because you've given them all the risks, one of those risks is you may lose all your money. And if you've crossed all your T's, dotted all your I's, and done everything you're supposed to, and you end up losing money, that's the risk that's on the investor.
Well, Mauricio, thank you so much for joining us. Kerri, thank you for being vulnerable and coming on as our rookie investor to learn about raising money. So Mauricio, where can people find out more information about you?
Find me on Instagram. Not that hard to find, but Instagram's my preferred these days. Just Mauricio Rauld. Just shoot me a DM. Happy to connect.
And my favorite podcast, Drunk Real Estate. Also, Mauricio is one of the co-hosts. And Kerri, where can people reach out to you?
So I just started my LLC. It's called Moonwater Events, and I'm on Instagram as well.
Cool.
Okay, you guys, thank you so much for joining us with Kerri and Mauricio. Did you guys like this video where we took a rookie investor and paired them up with an experienced person that is an expert in some kind of area, and they can ask their questions to get some clarification on what are their options and what's the best route for them as a real estate investor starting out. Thank you so much for joining us. And if you haven't already, make sure you are subscribed to our YouTube channel. We're releasing a new YouTube video every Tuesday, and then our podcast videos will be released throughout the week on Monday, Wednesday, and Friday. And we have a rookie resource. This is the videos where I am bringing you guys a downloadable, a template, a checklist to take home with you after watching the videos. I'm Ashley Kerr, and I'll see you on the next video for Real Estate Rookie.